It would have been pretty cool to have invested in a company that has grown at 26% for 20 years. This is one of the all-time great serial acquirers out of Sweden. I think the biggest surprise when looking at this company is not only have they been able to stay decentralized and quite programmatic with their acquisitions, is that they're really only in three kind of industrial areas at the moment. So there's a lot of room for them to grow. There's no reason why they can't expand into a fourth and a fifth and a sixth and start accumulating businesses in those areas and just keep this train going. Now, after thinking a long time and studying this company, I've actually started looking at this about 18 months ago. LIFCO is using about 130 to 140% of its capital for acquisitions. So that's a lot of their cash plus quite a substantial amount of debt. The return on capital employed is sitting at about 23%, and it has been consistently 15 to 25% for decades. But because they have to pay tax and because they have a dividend policy of somewhere between 30 and 50%, we're not going to get the full power of this acquisition engine, unfortunately. So we're not going to get that 23% return on capital employed because some of the money is leaving the business. I think about 15% per annum medium-term business growth is about what we can expect. But don't think, oh, it's just 15%. Being a great disciplined serial acquirer, this is like a rock solid 15%. It's more reliable than most companies out there because they're so diversified. And like 15% is still very strong. I could go on and on about this company and analyze all the details about how this is such an epic business. It's just a great study of the art of being a serial acquirer. But there's a lot of write-ups out there and there's a lot of other videos on LIFCO, and you can read the annual reports and figure that stuff out yourself. I'm here today to simply figure out and calculate the expected return if you were to invest at today's prices. Now, I update this in yes stocks, no stocks each week, and there's a link in the description for that. It's a very easy email to open each week and see where we are regarding valuations. Now, I know you shouldn't need a spreadsheet to calculate the fair valuation of things, but I need a spreadsheet to calculate it because I'm not that great at math, and it's easy for me to see if I put this in a spreadsheet. You'll see it on the screen. Here we go. So the first thing I'm trying to calculate is in 5 years' time, what will the revenue be? So I've got in the current revenue and I'm extrapolating that out at 15% per annum. And therefore, that's how I get this 5-year target revenue number. Then I figured out, based on reading the historical financials and what the company is targeting and how they've been optimizing their businesses, all this type of stuff, I think they can get about a 13% sort of free cash flow, like operating cash flow minus maintenance capex number. Sorry, that's a margin I think they can get, 13%. So that tells me like 13% of the revenue gives me like sort of a free cash flow number. Put a fair multiple on that. Such a great business, such a great track record. I think they warrant about a 20x multiple. I think we could ask for that. Historically, that's something that they've easily been able to achieve. They're above 20x most of the time anyway. So putting 20 times the free cash flow, we get a target market cap here. And there hasn't been much of a dilution rate. I think it's 0. And I put the shares outstanding, the current market cap. It tells me in 5 years' time, the target share price is about 275, somewhere around there. That's just a ballpark number, but it's not saying it's 400. It's not saying it's 1,000. It's telling me it's somewhere around, let's call it somewhere between 250 and 300. And that's really, at today's prices, only going to give us somewhere around 5% return per annum for the 5 years. And unfortunately, that's not strong enough for what I'm looking for, but this is a great business and maybe they surprise me on the upside here, but I just don't see big returns coming out of LIFCO at these prices. But the stock market is a volatile place, so I like to keep track of such good quality companies. That's why I have yes stocks, no stocks. The broker that I use if I was to invest in LIFCO would be Interactive Brokers. There's a link in the description for that if you want to take it for a test drive. There's a demo account you can use. I highly recommend using it. You really should have at least 2 brokers. So if you've already got one, I highly recommend getting Interactive Brokers because splitting a risk between 2 brokers is a smart idea. Hope you like this style of video and I will see you in the next one.